Here's what the retirement industry has never modeled for you. There is a specific number, somewhere between $500,000 and $1 million in saved assets, where every additional dollar you accumulate starts working against you in ways your 401k statement will never show. Not because saving is bad, because past a certain threshold, the problem stops being the size of the pile and starts being how the pile is structured, when it gets taxed, and the uncomfortable fact that most people who cross $500,000 will die with the majority of it unspent anyway. The financial machine will keep clapping as you add more. A 2025 study published in the Financial Planning Review found that 65-year-old couples with retirement assets of $100,000 or more draw down only 2.1% of their balances annually, not the 4% the whole industry is built around. 2.1. They spent 30 years building the suitcase. They arrived at the destination and barely opened it. So I want to tell you what actually changes at $500,000. Why the second half of wealth building follows completely different rules than the first, and why the most expensive financial mistake most serious savers make isn't picking the wrong fund, it's optimizing for a number when they should be optimizing for a system. The metaphor I'm going to use throughout this video is the overpacked suitcase. You are heading on a long trip, you have the bag. In the beginning, every item you add genuinely matters. Passport, phone charger, one clean shirt. The bag is doing its job. But at some point around 3/4 full, the math inverts. Every new item you stuff in doesn't improve the trip. It makes the bag heavier to carry, slower through security, and more likely to take up an extra 30 minutes at baggage claim. And when you get to the destination and finally unzip it, you discover you packed 4 suits for a beach vacation. The extra stuff costs you energy and friction and stress at every step of the journey, and you never needed any of it. That overpacked suitcase is your traditional 401k. And right now, most of the people watching this video are still standing at the departure gate, stuffing in another sweater, convinced the problem is that they don't have enough shirts. In a few minutes, I'm going to show you exactly how the IRS has a very specific and very scheduled plan for the money you are currently saving on a tax-deferred basis, a plan that doesn't activate until age 73, when your flexibility to respond is dramatically reduced. But first, let me walk you through why the just keep saving more instinct, which served you perfectly until now, becomes a different kind of problem on the other side of $500,000. The idea that accumulation is the goal is one of the most deeply embedded pieces of financial conditioning in American culture. And it's correct up to a point. When you're going from $0 to $100,000, every additional dollar saved has extraordinary leverage. You are building survival infrastructure. The gap between having 3 months of expenses saved and 12 months is not just a number, it's the difference between financial fragility and financial stability in practical daily terms. The gap between $50,000 invested and $100,000 invested is meaningful. The marginal value of each additional dollar is genuinely high. But here is where the logic breaks. As your wealth passes certain thresholds, the marginal utility of each new dollar you add declines. Not to zero, but sharply. The economists have been writing about this for over a century. Alfred Marshall formalized it in 1890. What changes at $500,000 in retirement savings is that you have crossed from the high utility zone into a zone where the next dollar saved has diminishing returns to your actual retirement outcome, while the costs in time, in tax structure, and in something much more finite remain constant or increase. There are 4 specific mechanisms through which saving more past $500,000 starts working against you. I'm going to walk through all 4. And the last one is the one that hit me hardest when I actually did the math. The first mechanism is the one that waits for you quietly at age 73, and it is not subtle. When you put money into a traditional 401k or a traditional IRA, you made a deal with the government. You could skip the taxes now, let the money compound without drag, and pay the taxes later in retirement when, the theory goes, you'll be in a lower bracket. In your 20s and 30s and 40s, this was a good deal. The math worked. The tax deferral created real compounding leverage. But the deal always had a clause that most people don't read carefully until it is already too late. After age 73 or age 75, if you were born in 1960 or later, the IRS mandates that you begin taking required minimum distributions from every traditional tax-deferred account you own. Every traditional IRA, every 401k, every 403b, every year, whether you need the income or not, whether the market is up or down, whether you are planning to spend the money or not. They call it an RMD. And if you don't take it on time, you face a 25% excise tax on the amount you failed to withdraw, not 25% of your gains, 25% of whatever amount you missed. The government doesn't negotiate. Now here's where the size of your pile becomes a structural liability rather than a structural asset. The IRS uses a life expectancy table to calculate how much you must pull out each year. At age 73, your distribution period factor is 26.5. You divide your prior year-end account balance by that factor to get your mandatory withdrawal. If you have $500,000 in your IRA at age 73, your required minimum distribution is roughly $18,868. That is manageable. You can probably absorb that without major tax consequences, especially if your other income is limited. The suitcase is heavy, but you can carry it. But let's say you followed conventional advice. You kept the 401k contributions max. You added more. You got from $500,000 to $2 million. At age 73, your RMD on $2 million is approximately $76,923 per year. That is mandatory taxable income. Stack your Social Security benefits on top. The average retired worker benefit is $2,071 per month as of January 2026. So about $24,852 per year. Stack any other pension, rental income, or interest. And suddenly, without any planning on your part, your mandatory reported income is crossing 6 figures. The IRS is collecting on the deal you made decades ago, and they are collecting at the highest income moment of your retirement, not the lowest. But the story gets worse, because that RMD income doesn't just affect your federal tax bracket. It affects your Medicare premiums in a way that most retirement calculators never model. The mechanism is called IRMA, the Income-Related Monthly Adjustment Amount. It is a surcharge added to your Medicare Part B and Part D premiums when your modified adjusted gross income crosses certain thresholds. In 2026, the IRMAA threshold for a single filer is $109,000. For a married couple filing jointly, it's $218,000. If your RMD-driven income pushes you above that threshold by even $1, you are hit with the full surcharge for that tier. This is a cliff system, not a slope. $1 over the line triggers the entire surcharge. Tier 1 IRMAA in 2026 costs roughly $1,148 per year per person in additional Medicare premiums. The maximum surcharge at the highest tier is $6,936 per person per year. For a married couple both enrolled in Medicare and both at the highest tier, that is nearly $14,000 per year in surcharges, on top of the standard premiums, just in Medicare, because you saved too much into the wrong account type. You spent 30 years building the suitcase. The airline is charging you $200 overage fees at every checkpoint. The stuff in the bag hasn't grown or shrunk, but the cost of carrying it keeps adding up. This is where the accumulate more instinct reveals its first real flaw. You think you are solving the problem by making the pile bigger, but you're not solving the structure. A larger pile in a traditional tax-deferred account doesn't give you more freedom in retirement. It gives the IRS a larger mandatory withdrawal schedule and Medicare a larger surcharge target. Those are not abstract risks. They are predictable, calculable liabilities, and most people only discover them after the options to manage them have already expired. Now, this is where it gets really interesting, because what I just described is the visible damage, the tax hit you can eventually model on a spreadsheet. But there is a second mechanism that is arguably more destructive, and it operates entirely below the surface, inside your own head. By the way, hit subscribe if you like the content, otherwise the algorithm may never show you my videos again. A 2024 research paper called Guaranteed Income, A License to Spend, by Professors David Blanchett and Michael Finke, measured something remarkable. They found that retirees with assets converted into guaranteed income streams, think Social Security, pension payments, annuities, spent roughly twice as much as retirees holding an equivalent amount in a non-annuitized portfolio. The same dollar amount, double the actual spending. Their conclusion was that every dollar of assets converted to a guaranteed income source could produce roughly twice the equivalent lifestyle spending compared to a dollar left sitting in a brokerage or 401k account. Twice. Not because the math was different, because the psychology was completely different. Here is why that matters for you specifically. A large balance in a retirement account feels to your brain like a number you could burn through. It's a pile you might outlive. It triggers what behavioral economists call loss aversion, the very human tendency to feel the pain of a potential loss more acutely than the pleasure of an equivalent gain. When your retirement income feels precarious or abstract, your brain sends one signal: don't spend it. Hold on, you might need it. So people with $2 million in a 401k sit in a house with the heat turned down because they're worried about running out of money. A guaranteed income stream, a Social Security check that arrives every month regardless of markets, doesn't trigger that same fear response. It's a faucet, not a tank. And you spend faucet income more freely than tank income. The practical consequence of this is devastating when you run the arithmetic. Imagine you retire at 65 with $1,200,000 in a traditional 401k. The industry recommendation is 4% withdrawals per year, $48,000 annually. But the actual measured withdrawal rate for retirees in Blanchett and Finke's research is 2.1%. On $1,200,000, that is $25,200 per year. Add the average Social Security benefit of $24,852 per year. Your total annual income is roughly $50,000. You have more than $1 million in assets, and you are living on $50,000 a year. The suitcase is overflowing with cash. You never unzip it. The conventional advice machine will tell you the answer to this problem is to save more. Get to 1,500,000, then the worry goes away. But the behavioral research is very clear. It doesn't. The psychological pattern stays the same. More money in a non-annuitized account does not produce more spending confidence. You just have a larger pile you are too afraid to open. You don't need a bigger suitcase. You need to pack it differently. Think about a woman I read about in a financial planning case study. 71 years old, $280,000 in savings. By the numbers, she was underfunded. But she had a pension of $2,300 a month, plus Social Security. She spent freely, traveled twice a year. Her spending was aligned with her income. Compare her to the engineer across town with $800,000 in an IRA who monitored his balance every morning, ate at home every night, and told himself he'd start enjoying retirement once he felt more secure. He never quite got there. His accountant later noted that his effective withdrawal rate over a decade of retirement was approximately 1.8%. He spent less than his state pension would have generated. The difference between these two people was not the size of the pile. It was the structure of the income. Here is the honest part that most retirement calculators don't show you. Knowing you have $1 million in a 401k is not the same as having a system designed to turn that number into actual spending freedom. They are two fundamentally different things. And most people, including very smart, very disciplined people, learn this only after they've retired. I spent a serious amount of time building a framework that addresses this specific gap, not theory, not motivational language, actual 50 years of retirement data compressed into a practical guide I called the exit code. Two pieces of it are directly relevant to what I've been describing. The first is what I call the $14,000 invisible bill, the real modeled cost of healthcare coverage for someone who retires before 65 and needs to bridge to Medicare eligibility. Most early retirement calculators simply don't account for this at all. and it can erase multiple years of projected runway overnight. The second piece is a dynamic withdrawal framework that replaces the static 4% rule, which Morningstar's 2026 research now puts at a 10% failure probability over 30 years, with a rules-based method that adjusts spending based on what the market is actually doing, rather than mechanically selling at the worst prices in the worst years. If you are between $500,000 and $1 million in saved assets and thinking about how to structure the next phase, you can get the full thing for less than 1 hour with a mediocre financial advisor through the link in the description. Now, I want to introduce a concept that the retirement advice industry almost completely ignores. Because once you understand it, the entire instinct of bigger pile equals more safety starts to look like a category error. There was a man I'll call James. He spent his career working in manufacturing, meticulous saver. Hit $1,100,000 in his 401k at age 63. His neighbor Robert retired the same year with $1,100,000 in an identical index fund portfolio. Same balance, same asset allocation, same average annual return over the next 25 years. At age 88, James had over $2 million left. Robert had run out of money 7 years earlier. They had the same portfolio, they had the same returns. One thing was different, the sequence. James retired into a bull market. His portfolio grew strongly in years 1 through 8 of retirement. He withdrew 4% per year from a rising base. The math worked in his favor. Every withdrawal was a smaller and smaller percentage of a growing pile. Robert retired into a market downturn. His portfolio dropped 28% in year 2 of retirement, while he was simultaneously pulling out $43,000 per year to live. Those shares he sold at depressed prices were gone permanently. They could not participate in the eventual recovery because they no longer existed in his portfolio. The recovery happened, but it happened on a smaller base. Robert ran out of money because he started with bad luck, not because he planned poorly. Research by Wade Pfau, a professor of retirement income at the American College of Financial Services, has directly quantified this. The compounded return in the first 10 years of retirement accounts for approximately 77% of the final retirement outcome. 77% of everything that ultimately happens to your money in retirement is determined by what happens in the first decade. And Morningstar's 2026 research confirms that a 4% withdrawal rate now carries a 10% failure probability over 30 years, even at moderate equity allocations. Here is the reversal that changes how you need to think about this. You think the problem is not having a large enough pile to survive a bad sequence. But the actual problem is not having a large enough buffer to avoid selling during a bad sequence. Those are not the same problem, and the solutions are completely different. A retiree with $1 million and a 2-year cash buffer, 18 months to 2 years of living expenses held in cash or short-term bonds can ride out a 30% market decline without selling a single share of equity. They wait. The market recovers. Their underlying portfolio participates in that recovery because they never sold at the bottom. A retiree with $2 million and no cash buffer who is forced to sell equities in year 2 of a bad market to fund living expenses can permanently impair that portfolio in ways no amount of subsequent recovery fully repairs. More money did not solve the problem. The right structure solved the problem. The suitcase analogy snaps into focus here. You think you need to pack a bigger suitcase to handle any weather condition. What you actually need is to put your rain jacket in the outside pocket where you can get to it quickly instead of buried at the bottom under your dress shoes. Accessibility, liquidity, structure, not size. Let me give you a concrete scenario so this stops being abstract. His name is Mark. He's 52 years old. He has $500,000 in a traditional 401k. He earns around $110,000 a year. He is currently maxing his 401k at the 2025 contribution limit, $23,500 per year, including the catch-up contribution for his age. This is textbook disciplined behavior. His financial advisor is happy. Path 1. Mark keeps doing exactly what he is doing. He contributes $23,500 per year to his traditional 401k for 15 more years until age 67. At 7% average annual return, his $500,000 alone grows to approximately $1,378,000. His annual contributions at the same rate of return add another $591,000. Total at 67, about $1,970,000. Call it $2 million. His financial advisor sends him a congratulations email. The suitcase is packed. At age 73, with 6 more years of compounding at 7%, his balance is approximately $3 million. His required minimum distribution is roughly $113,000 per year, mandatory, whether he needs it or not. Stack Social Security, stack any other income. He is solidly above the $109,000 IRMA threshold for single filers in 2026, and likely in a higher federal tax bracket than he expected. His financial advisor charges 1% of assets under management, the standard AUM fee, used by 92% of advisors, according to the 2024 Kitces Research Survey of 621 US-based advisors. 1% on $3 million is $30,000 per year in annual fees for the privilege of being told he saved too much into the wrong type of account. Imagine a financial advisor explaining this to a client. Sir, your discipline has created a mandatory taxable income stream of over $100,000 per year at age 73, which will trigger Medicare surcharges, push up your federal tax bracket, and force you to spend money you do not currently need. Also, here's my invoice for $30,000. That is not a joke. That is what the math produces. Path 2. Mark at 52 keeps contributing to his 401k up to only his employer match. He redirects the difference, let's say $16,000 per year, into a Roth IRA and a taxable brokerage account. He uses the lower income years between 62 and 67 after he stops working, but before Social Security begins, to do systematic Roth conversions. He moves money from the traditional account into a Roth account, paying taxes now at a lower rate, shrinking the future RMD obligation. By 67, his total accumulated assets are similar in size, but the composition is completely different. A significant portion lives in Roth accounts with no required distributions, no IRMAA impact, no mandatory income at 73. His tax situation in retirement is controllable. And somewhere between ages 53 and 60, he took the trip. He upgraded the car with 250,000 miles on it. He was present for his kids' last years at home. Same lifetime income, same market returns, dramatically different retirement quality and tax outcome. The difference isn't how much Mark saved. The difference is where he saved it and what he gave up in the years when his health and energy were at their peak. Mark's advisor, by the way, never suggested path 2. And Michael Finke, the wealth management professor who co-authored the unintended bequest research, wrote explicitly about why. The loss of welfare from systematic underspending is likely much larger than any difference in advisory fees. But fixing underspending means helping clients spend, and spending doesn't generate assets under management fees. Asset compensated advisors have a structural incentive to maximize the pile, not optimize the experience of spending it. That's not a conspiracy. That's an incentive structure. And it's been documented academically. Now here's the part of this video that I've been building toward. The number that should unsettle you more than any sequence, risk chart, or tax bracket comparison. 58% of Americans retire sooner than they planned. That statistic comes from the 2024 study on retiree life in the post-pandemic economy by the Transamerica Center for Retirement Studies, which surveyed thousands of active retirees about what actually happened to their retirement timelines. Among those who retired earlier than planned, 46% did so for personal health reasons. 43% left the workforce due to employment-related issues, layoffs, company restructuring, a role that simply no longer existed in their organization. Only 21% retired early because they were financially able to. Think about those numbers for a moment. 58%, more than half, left earlier than planned. And of those people, only about 1 in 5 made the choice voluntarily. The rest were pushed out by their bodies or their employers. This means that when you are 48 years old and telling yourself you have 17 more years to maximize contributions, to pack the suitcase to its absolute limit, the actual data says you probably have somewhere between 8 and 12 years of active contribution capacity. Not 17, maybe not even 10. And now apply the compounding math to what you already have. If you are 48 right now and you have $500,000 saved, and the market returns 7% annually from here, your portfolio reaches $1,935,000 by age 65 without a single additional contribution. You read that correctly. The machine is already running. The compounding on what you already have is doing the work. Every additional dollar you contribute past this point has an explicit cost. It is being purchased with your current time, your current health, your current energy, the exact resources that allow you to enjoy what the pile is supposed to eventually buy. And those resources are finite in a way that the pile is not. There is something I have to tell you about a man I'll call David, because the pattern of his story shows up in the numbers with uncomfortable frequency. David was a structural engineer. He crossed $500,000 in his 401k at 46, and he barely noticed. He'd already moved the target. He told himself he needed $1,500,000 to feel genuinely secure. He drove a car with 200,000 miles on it. He took the same beach house rental every summer because it was cheaper than trying somewhere new. He ate the same lunch at his desk every day and thought of it as discipline. He told his kids that soon we'll have more freedom. He believed it. He was not fooling himself. He was making a plan. He crossed $1 million at 55. He could see the finish line. He crossed $1,200,000 at 59, $30,000 from his target. At 62, he got a cancer diagnosis. Treatable, but not without consequences. The kind of treatment that changes what your body can do and what your energy looks like at 65. The retirement he had been planning, the active one, the one with hiking and travel and long summers outdoors, was not quite the retirement that would be available to him anymore. David's money is fine. The pile he built is intact and growing. What he traded for it is not. I'm not telling you this to be morbid. I'm telling you this because the human tendency to optimize for the pile and discount the cost of the time spent building it is not a personality flaw. It is a feature of how we think about the future. The future feels abstract. The pile feels concrete. But those years from 50 to 62, the last decade before the statistical forced exit zone, are often the years with the highest combination of income, health, and flexibility. They're the years when the trade-off is most expensive, not least, and David's situation resolved. He is managing, he still has the money, but he also has the clear-eyed understanding, which he shared with anyone who asked, that he built a suitcase that was larger than any trip he'll now be able to take. That is the kicker. The thing you are deferring isn't just a trip or a car or a dinner. It is the window of time when your body can fully participate in the life the money is supposed to fund. That window is shorter than you think, less predictable than you think, and it cannot be bought back once it closes. 3 practical things you should actually do if you're between $500,000 and $1 million in savings right now. First, project your RMD obligations today. Take your current traditional 401k and IRA balances. Apply a conservative 6% annual return, and calculate what those balances will look like at age 73. Then divide by 26.5. That is your mandatory annual taxable income at the start of RMDs. Add your estimated Social Security benefit. Add any other income. If the number crosses $109,000 as a single filer or $218,000 as a joint filer, you have a calculable IRMA liability waiting for you. You can reduce it through Roth conversions in the years between now and when RMDs begin, specifically in the window between retirement and Medicare enrollment, which is typically the best Roth conversion window of your entire financial life. Do this math now, not at 72. Second, build the income architecture before you keep building the pile. This is the structural answer to both the behavioral trap and the sequence risk problem. 2 years of living expenses in cash or short-term bonds. A Roth balance you can draw from tax-free, Social Security delayed as long as your health allows. The benefit grows by approximately 8% per year for each year you delay past 62. And those are guaranteed, inflation-adjusted, government-backed returns that no market crash can take away. The first 5 years of retirement are the most dangerous window for sequence of returns damage. Amy Arnott at Morningstar calls it the danger zone. Have a plan for that window that does not require selling equities at the worst possible prices. Structure protects you. Size alone does not. Third, calculate what each additional year of maximum saving is actually costing you. The pile at $500,000 is already working. It is already growing. The compounding does not stop when you stop adding to it. What you are trading for every additional dollar of contribution past the structural necessity is time, specifically time with a body that is currently capable of using the money you're building. Run the math. If the pile is already on track, if the RMD projections are already concerning, if the structure is already wrong, the next sweater in the suitcase might be the one that makes the bag impossible to carry. Lazy investing built more fortune than crypto memes. And the people who figured that out early are the ones who stopped packing around the right number and started actually unpacking at the destination. The retirement industry will keep selling you bigger bags. They charge by the ounce. Research published in 2025 by David Blanchett and Michael Finke in the Financial Planning Review revealed that 65-year-old couples holding retirement assets of $100,000 or more draw down only 2.1% annually. For unmarried retirees in the same category, the withdrawal rate is even lower at approximately 1.9%. As of 2025, the magic number for retirement was $1.26 million, according to a survey of U.S. adults by Northwestern Mutual. Almost 6 in 10 retirees retired sooner than planned, and among them, almost half did so for personal health-related reasons and 43% for employment-related issues. Only 1 in 5 retired early because they were financially able. For example, a 75-year-old single retiree who ended the previous year with $2 million in an IRA would have a required minimum distribution for the following year of $81,301, based on a distribution period factor of 24.6. Once you reach age 73, the IRS mandates annual withdrawals from your traditional 401k and other pre-tax accounts, and every dollar counts as ordinary income. That mandatory income can push retirees into higher federal tax brackets, trigger the taxation of Social Security benefits, and raise Medicare premiums by thousands of dollars each year through IRMA. In 2026, the IRMA threshold is $109,000 for a single individual and $218,000 for a married couple. Medicare beneficiaries who earn over $109,000 a year and who are enrolled in Medicare Part B and/or Medicare Part D pay the income-related monthly adjusted amount surcharge added to the Part B and Part D premiums. It only takes earning $1 above the threshold to trigger the surcharge. In 2026, that $1 of income would cost an additional $1,052.40 annually in Medicare surcharges, consisting of $974.40 for Part B and $174 for Part D. In their June 2024 study, Guaranteed Income, a License to Spend, Blanchett and Finke determined that retirees with assets that annuitize income spend twice as much as retirees with an equal amount of non-annuitized savings. Consequently, every $1 of assets converted to guaranteed income could result in roughly twice the equivalent spending compared to money left invested in a portfolio. Research by Wade Pfau estimates that approximately 77% of a portfolio's final retirement outcome can be explained by the returns of just the first 10 years. According to Morningstar's 2026 research, portfolios with higher equity allocations above 50% show lower safe withdrawal rates, supporting only 3.9% withdrawals for 90% success over 30 years. A 4% withdrawal rate now carries a 10% failure probability over 30 years at moderate equity allocations. Your first 5 years of retirement are the danger zone for tapping accounts during a downturn, according to Amy Arnott, a portfolio strategist with Morningstar Research Services. The assets under management model is the most widely used fee structure among financial advisors. In fact, 92% of advisors use an AUM fee structure, with 86% relying on AUM fees as their main source of revenue, according to the Kitces report. The loss of welfare from underspending is likely much higher than from choosing one or the other fee method. Unspent savings is an ignored fiduciary problem. According to the Social Security Administration's 2026 data, the average monthly benefit payable in January 2026 is $2,071 per month.